In the heady days before the 2008 financial crisis, Wall Street was a kingdom of its own. And among its most powerful rulers was a man named Raj Rajaratnam. He was not a household name like the heads of big banks, but within the exclusive, high-stakes world of hedge funds, he was royalty. Rajaratnam was the founder and manager of the Galleon Group, a massive firm that at its peak managed over $7 billion. He had built this empire from the ground up, earning a reputation as one of the sharpest, most aggressive, and most successful traders of his generation. His story was the embodiment of the American dream, a tale of an immigrant from Sri Lanka who had climbed to the very top of the financial world through sheer force of will and intellect. The Galleon Group was not just another hedge fund. It was a behemoth, known for its focus on technology and healthcare stocks. Rajaratnam and his team of analysts were famous for their deep, almost obsessive research. They prided themselves on knowing more about the companies they invested in than anyone else on the street. They would talk to suppliers, customers, and industry experts, piecing together a mosaic of information to predict a company's future performance. This relentless pursuit of knowledge gave them an edge, or so it seemed. Galleon's returns were consistently spectacular, making its investors, and Rajaratnam himself, incredibly wealthy. He lived a life of unimaginable luxury, with homes across the world and a private jet at his disposal. What made Galleon so important was its influence. When Galleon made a big bet on a stock, others noticed and often followed, believing that Rajaratnam's team had uncovered something valuable. The firm was a market mover, a force that could help shape the fortunes of major corporations with its investment decisions. Rajaratnam was seen as a master of information, a man who could connect the dots in ways others could not. He cultivated a vast network of contacts, a Rolodex filled with the names of powerful executives, consultants, and fellow traders. This network, he claimed, was the secret to his success, providing him with the insights that kept him one step ahead of everyone else in the cutthroat game of high finance. But beneath the surface of this glittering success story, a different reality was taking shape. The edge that Galleon possessed was not always the product of brilliant analysis or diligent research. It was often something far simpler and far more illegal. Rajaratnam wasn't just connecting the dots. He was being handed the answers. His extensive network was not merely a source of industry chatter. It was a pipeline for confidential, market-moving secrets. The king of the hedge fund world had built his castle on a foundation of lies, and federal investigators were slowly, methodically, beginning to uncover the truth about how the Galleon Group really made its money. The fall from grace would be as dramatic as the rise to power. To understand the crime that brought down Raj Rajaratnam, one must first understand the concept of insider trading. At its core, the idea is about fairness. Imagine the stock market as a giant, complex game where everyone is trying to win by buying and selling shares of companies. The rules of this game state that all players should have access to the same public information when making their decisions. This includes a company's quarterly earnings reports, official press releases about new products, or public announcements about a potential merger. This creates a level playing field, where success is supposed to depend on skill, analysis, and a bit of luck. Insider trading happens when someone breaks this fundamental rule. It is the act of trading a stock based on material, non-public information. Material means the information is important enough that it would likely affect a company's stock price. For example, knowing that a company is about to be bought by a much larger firm is material information. Non-public means this information has not been shared with the general public. It's a secret known only to a small group of people inside the company, such as executives, lawyers, or board members. Using this secret knowledge to buy or sell stock before the news becomes public is illegal because it gives the insider an unfair advantage over everyone else. The accusation against Raj Rajaratnam was that he was the master of this illegal game. Prosecutors alleged that he had systematically corrupted a network of sources to feed him a steady stream of corporate secrets. He wasn't just taking advantage of a single lucky tip. Instead, he had built a sophisticated machine designed to acquire and exploit inside information on a grand scale. The Galleon Group, prosecutors argued, was not just a hedge fund, it was a criminal enterprise. Rajaratnam's crime was not a one-time lapse in judgment, but a core part of his business strategy, a strategy that generated hundreds of millions of dollars in illegal profits and cemented his status as a Wall Street titan. This was not a simple case of one person acting alone. The government's case painted a picture of a sprawling conspiracy. Rajaratnam was at the center of a web, with threads reaching into the boardrooms of some of America's most respected companies, including Goldman Sachs, Intel, and IBM. He was accused of paying sources for secrets, pressuring them for more information, and using this illegal edge to make bets that seemed to the outside world like pure genius. He was, in essence, playing the game with a stacked deck, knowing the outcome of events before they ever happened, while ordinary investors could only guess. This, prosecutors would argue, was not just cheating. It was a fundamental betrayal of the trust that underpins the entire financial system. Every major investigation begins with a thread, a single piece of evidence that, when pulled, unravels a much larger story. For the federal investigators looking into Raj Rajaratnam, that thread was a series of suspiciously timed trades. Long before any arrests were made, regulators at the Securities and Exchange Commission, the government agency responsible for policing the markets, began noticing a pattern. It seemed that the Galleon Group had an uncanny ability to make large, profitable bets on companies just before major news was announced to the public. This happened too often to be explained away as simple luck or brilliant analysis. One of the first red flags was raised around the 2006 acquisition of the computer hardware company ATI Technologies by the chipmaker Advanced Micro Devices. The SEC noticed that several hedge funds, including Galleon, had bought huge amounts of ATI stock in the days leading up to the public announcement of the deal. When the acquisition was made public, ATI's stock price soared, and these funds made millions of dollars in instant risk-free profit. It was a classic sign of insider trading. The trading was too perfect, too timely. It was as if the traders knew the future, a power no legitimate analyst could ever possess. This pattern of trading set off alarms within the SEC. The SEC's civil investigators began digging deeper, a process they called blue sheeting. This involves requesting trading records from brokerage firms to see who was buying and selling a particular stock and when. As they examined the data surrounding the ATI deal and other suspicious mergers, one name kept appearing again and again: Raj Rajaratnam and the Galleon Group. The sheer volume and consistency of Galleon's well-timed trades were staggering. It wasn't just one lucky bet, it was a recurring theme across dozens of different stocks and corporate events. The evidence was circumstantial, but the pattern was too strong to ignore. But the SEC faced a major problem. Proving insider trading is notoriously difficult. To win a case, you have to prove not only that a trader possessed secret information, but also that they received it from an insider who breached a duty of trust, and that the trader knew it was illegal. Just showing a pattern of lucky trades is not enough. Defense lawyers could argue it was just good research or even a coincidence. For years, this high burden of proof allowed many on Wall Street to operate in a gray area. The SEC knew something was wrong at Galleon, but they needed more than just trading records. They needed a smoking gun. They needed to hear the secrets being passed. Faced with the challenge of proving their case against Rajaratnam, federal prosecutors from the United States Attorney's Office for the Southern District of New York decided to do something unprecedented in a white-collar financial crime investigation. They decided to use a tool that was typically reserved for pursuing mob bosses and drug kingpins, the wiretap. For the first time, the government would seek a judge's permission to secretly record the phone conversations of a major Wall Street figure. It was a bold and controversial move. Getting a wiretap warrant is legally difficult, as it requires showing probable cause that a crime is being committed and that other investigative methods have failed. The prosecutors argued that Rajaratnam's network of informants was so secretive and sophisticated that traditional methods, like interviews and subpoenas for documents, would not be enough to crack the case. The only way to get undeniable proof of the conspiracy was to listen in on the conversations themselves. In March 2008, after presenting their evidence to a federal judge, they were granted the authority to tap Rajaratnam's cell phone. Suddenly, the investigators had a direct line into the heart of the alleged conspiracy. Every call he made and received was recorded, transcribed, and analyzed by a team of FBI agents. This was a game changer. The tapes were a goldmine of evidence. On the recordings, prosecutors heard Rajaratnam speaking in a kind of code, but the meaning was often clear. They listened as his sources, some of them high-level corporate executives, fed him confidential information. They heard details about upcoming earnings reports that had not yet been released to the public, secret merger negotiations, and other market-moving news. The calls captured the raw, unfiltered reality of how the information flowed. There was no ambiguity. For example, in one call, an informant tells Rajaratnam about an upcoming deal, and Rajaratnam immediately instructs his traders, buy, as many as you can. These recordings transformed the case from one based on circumstantial evidence, the suspicious trades, to one built on direct, irrefutable proof. The prosecutors now had Rajaratnam's own voice on tape, discussing illegal tips and directing trades based on them. They could hear the tone of urgency, the casual exchange of corporate secrets, and the clear understanding between Rajaratnam and his sources that what they were doing was wrong. The wiretaps did more than just confirm the investigators' suspicions. They provided a detailed, minute-by-minute account of the criminal enterprise in action. This powerful new evidence would become the centerpiece of the government's case and would send a shockwave through Wall Street. The wiretaps did not just incriminate Raj Rajaratnam, they exposed the vast and intricate network of sources he had cultivated to feed him illegal information. This was not a random collection of contacts, but a carefully constructed web of insiders placed in strategic positions across the corporate world. These individuals, often highly paid and respected professionals, were willing to betray the trust of their employers and shareholders in exchange for money, friendship, or, just the thrill of being connected to a powerful hedge fund titan. The investigation revealed a culture of casual corruption where leaking confidential information was treated as just another part of doing business. One of the key figures in this network was Anil Kumar, a senior partner at the prestigious global consulting firm McKinsey & Company. Kumar had known Rajaratnam for years, and prosecutors alleged that he was paid hundreds of thousands of dollars for providing secret information about McKinsey's clients, including the chipmaker AMD. On the wiretaps, Kumar could be heard giving Rajaratnam a heads-up about the impending ATI acquisition. In exchange for these tips, Rajaratnam funneled payments to Kumar through an offshore shell company, a classic tactic used to hide illegal transactions. Kumar's betrayal was particularly shocking given his senior position at a firm that prided itself on discretion and integrity. Another important source was Rajiv Goel, a director of strategic investments at Intel, one of the world's most important technology companies. Goel and Rajaratnam had been friends since their days at the Wharton School of Business. Prosecutors used the wiretaps to show that Goel provided Rajaratnam with confidential details about Intel's quarterly earnings, before they were released to the public. He also leaked information about a major new joint venture that Intel was planning. This advanced knowledge allowed Gallion to make perfectly timed trades, earning millions in profits. Goel was not paid in cash, but was rewarded with profitable trades in his personal brokerage account, guided by Rajaratnam. The network extended far beyond just these two men. It included executives at other major companies like IBM, and even other hedge fund traders who swapped information in a so-called circle of trust. One by one, as the FBI listened to Rajaratnam's calls, they identified the members of this conspiracy. The wiretaps gave them a roadmap, leading them from one source to the next. The investigation revealed that Rajaratnam was the sun in this corrupt solar system, with insiders from various industries revolving around him, all feeding him the secret information that fueled his fund's incredible returns. The scale of the network was, honestly, just breathtaking, and showed just how deep the rot on Wall Street went. Perhaps the most shocking revelation to come out of the Gallion investigation was the involvement of a man named Rajat Gupta. This was not just another mid-level executive or consultant. Gupta was a giant in the world of global business. He had served as the worldwide managing director of McKinsey & Company for nearly a decade, and at the time of the investigation, he sat on the board of directors of several major corporations, including the powerhouse investment bank Goldman Sachs. His position gave him access to the highest levels of corporate America and some of its most sensitive secrets. His alleged betrayal struck at the very heart of the financial establishment. The case against Gupta centered on a single dramatic phone call that took place on September 23, 2008, at the height of the financial crisis. Goldman Sachs was in turmoil, and its board held an emergency meeting to approve a crucial $5 billion investment from Warren Buffett's Berkshire Hathaway. This news was a massive vote of confidence that was certain to send Goldman's stock price soaring. The board meeting ended at 3:56 p.m. Phone records showed that just seconds later, at 3:56 and 15 seconds, a call was placed from Gupta's line to Raj Rajaratnam's direct line at Gallion. Immediately after that brief call, Rajaratnam ordered his traders to buy huge quantities of Goldman Sachs stock. He managed to purchase over 175,000 shares in the final minutes before the market closed at 4 p.m. When the Buffett investment was announced to the public after the closing bell, Goldman's stock surged in after hours trading. The next morning, Gallion sold its shares for a quick, nearly $1 million profit. For prosecutors, the timing was too perfect to be a coincidence. They argued that Gupta, in his capacity as a Goldman director, had learned of the Buffett deal and immediately tipped off his friend and business partner, Rajaratnam, breaching his sacred duty to the bank and its shareholders. Gupta's case was tried separately from Rajaratnam's, and he fiercely maintained his innocence, arguing that he had no financial motive and that his relationship with Rajaratnam was legitimate. However, the circumstantial evidence was incredibly powerful. The phone call, placed just seconds after the board meeting ended and just before Rajaratnam's massive stock purchase, created a narrative that was difficult to refute. While there was no wiretap of that specific call, prosecutors used it in conjunction with other recorded conversations where Rajaratnam discussed receiving information from a source on the Goldman board. Gupta was ultimately convicted, and his downfall sent a powerful message: no one, no matter how powerful or respected, was above the law. To see the Gallion insider trading scheme in action, one need look no further than the acquisition of ATI Technologies by Advanced Micro Devices in 2006. This single deal perfectly illustrates how Rajaratnam combined information from multiple independent sources to gain an illegal and unbeatable edge. It showcases the methods he used, the key players involved, and the massive profits that resulted from their criminal conspiracy. The story of the AMD deal became a centerpiece of the government's case, providing the jury with a clear and compelling example of how Rajaratnam operated. The first stream of information came from Anil Kumar, the McKinsey partner who was advising AMD on the secret acquisition. Months before the deal was public, Kumar began feeding Rajaratnam details about the negotiations. He provided updates on the timing of the deal and the price being discussed, all of which was highly confidential client information. On the wiretaps played in court, the jury heard Kumar telling Rajaratnam that the deal was getting close. This tip from a high-level consultant gave Rajaratnam the confidence to begin building a large position in ATI stock, knowing that a buyout was on the horizon. But Rajaratnam was not satisfied with just one source. He sought confirmation from a different corner of his network. He reached out to a source who worked at a so-called primary research firm, a type of company that connects hedge funds with industry experts. This source had contacts inside ATI, and through them, confirmed that something big was happening at the company. Rajaratnam also received information from an employee inside the Moody's credit rating agency, who was working on rating the debt for the deal, further corroborating that the acquisition was imminent. He was piecing together a puzzle, using pieces that were all stolen from different places. With this mosaic of illegal information, Rajaratnam knew the deal was a virtual certainty. He instructed his traders at Galleon to buy millions of shares of ATI. When the deal was finally announced to the public on July 24, 2006, ATI's stock price jumped by about 20%. The Galleon Group immediately sold its position, realizing a profit of more than $20 million. This was not the result of smart analysis or diligent research. It was the direct result of a crime. The AMD deal was the perfect illustration of Rajaratnam's method: gather secret information from multiple insiders, confirm the tip, and then place a massive leveraged bet just before the news breaks. The arrest of Raj Rajaratnam on October 16, 2009 was just the beginning. It was not the end of the investigation, but the start of a cascade of enforcement actions that would ensnare dozens of other traders, executives, and consultants. The wiretap evidence was so powerful that it gave prosecutors immense leverage. Once they had someone on tape discussing illegal activity, they could approach that person with a choice: cooperate with the government and testify against others, or face a long prison sentence. Faced with this stark reality, many chose to cooperate, leading investigators further and further into the dark corners of Wall Street. The first dominoes to fall were the informants themselves. People like Anil Kumar and Rajiv Goel, who were caught on tape feeding Rajaratnam secrets, were confronted by the FBI. They quickly agreed to plead guilty and cooperate against their former friend and benefactor. Their testimony would be crucial in the trial against Rajaratnam, as they could explain to the jury exactly what was being discussed on the cryptic phone calls and confirm that they were indeed providing illegal inside information. Each cooperator led the government to another, creating a chain reaction that exposed the true breadth of the conspiracy. The investigation, which was codenamed Operation Perfect Hedge, expanded far beyond just the Galleon Group. As prosecutors followed the threads, they uncovered other, separate insider trading rings. They discovered that some of Rajaratnam's sources were also feeding information to traders at other hedge funds. This led to a wave of arrests and prosecutions across the industry. Prominent traders from firms like Newcastle and Level Global, some of whom were once star employees at Galleon, were also charged. The government even launched a raid on the offices of several hedge funds, an aggressive tactic rarely seen in white-collar cases, signaling a new, tougher approach. In the end, the Galleon investigation became the largest insider trading crackdown in a generation. More than 80 people were charged, and the vast majority were convicted or pleaded guilty, resulting in one of the most successful prosecutorial efforts in the history of financial crime. The domino effect that began with the wiretaps on Rajaratnam's phone ultimately brought down a whole network of corrupt professionals. The investigation painted a damning picture of an industry where cheating had become normalized, and it forced a painful reckoning for many on Wall Street who had long operated on the blurry line between aggressive information gathering and outright illegality. The conviction of Raj Rajaratnam in May 2011 and his subsequent 11-year prison sentence, at the time the longest ever handed down for insider trading, marked a turning point for Wall Street. The case was much more than the downfall of one man. It was a fundamental shift in how the United States government policed financial markets. The successful use of wiretaps in a major white-collar case created a powerful new precedent. It sent a clear and chilling message to the financial industry. The secret conversations that had long fueled the flow of illegal information were no longer safe. The government was listening. This new enforcement paradigm had a profound impact on the culture of hedge funds and investment banks. The casual exchange of so-called market chatter that often crossed the line into illegal tipping suddenly became much riskier. Compliance departments, which had often been seen as a sleepy back-office function, were beefed up and given more power. Firms began monitoring employee communications more closely and implementing stricter rules about talking to outside consultants and corporate insiders. The fear of a wiretap or a surprise visit from the FBI became a real and tangible deterrent, forcing a level of caution that had been absent for years. The Galleon case also redefined what it meant to be an insider. The prosecution of Rajat Gupta, a corporate director who did not personally trade on the information but passed it to a friend, solidified the legal principle that tipping is as illegal as trading. It reinforced the idea that corporate insiders have a fiduciary duty to protect confidential information, and breaching that duty, even without direct financial gain, is a serious crime. This put board members, executives, and their consultants on high alert, making them think twice before sharing sensitive details, even with close friends or business associates. Ultimately, the rise and fall of Raj Rajaratnam served as a dramatic cautionary tale. It stripped away the veneer of genius that had surrounded so many successful traders and exposed the ugly truth that, for some, that so-called edge was simply cheating. The case demonstrated that no one was too big or too powerful to be held accountable. By using the aggressive tools of organized crime enforcement, prosecutors leveled the playing field and changed the rules of the game. While insider trading will likely never be eliminated entirely, the Galleon scandal and the government's response to it ushered in a new era of scrutiny and accountability for Wall Street, leaving a legacy that continues to shape financial regulation to this day.